Welcome to this week's episode of Accredited Investor Markets Radio. Each week we speak with you about investing in alternative assets. Unbiased and beholden to no one, Accredited Investor Markets Radio does not accept advertising from any investment firm or financial advisor. Accredited Investor Markets Radio is the spoken word sister of AccreditedInvestorMarkets.com, the internet's most comprehensive and unbiased educational resource about crowdfunding, angel investing, venture capital, private equity, private shares, and other investment classes beyond publicly traded stocks and bonds.
Hello, everyone, and welcome to Accredited Investor Markets Radio. I am Christopher Cahill. In a little while, we'll be speaking with Neha Manaktala, who is the London-based founder and chief executive officer of DealIndex, an alternative finance aggregator. That is, it aggregates information on alternative finance and deal-making globally. But first, let's talk about The Prince. That's right, The Prince. The guide or manual by Niccolò Machiavelli. Specifically, The Prince relies heavily upon a metaphor, the metaphor of Fortuna's wheel, also called the Wheel of Fate or the Wheel of Fortune. And its ineffable turning, the ineffable turning of Fortuna's wheel, is to be borne in mind by the statesman, very powerfully borne in mind by the statesman, according to Machiavelli. It should also be borne in mind by the investor, is what I'm trying to suggest, and something which we will get to shortly here. And indeed, dealing with Fortuna's wheel is the reason why we have diversified portfolio investing. But anyway, back to Machiavelli. To deal with Fortuna's wheel, Machiavelli would have statesmen cultivate the quality of virtù, a word that Machiavelli created, V-I-R-T-U with an accent, which is not to be confused with virtue, especially virtue as equated with Christian goodness. No, virtù involves looking at human beings as they are, individually and in collectives, and then acting with audacity, cleverness, even deceit, to manage the turns of Fortuna's wheel with respect to individual or large groups of human beings. Machiavelli, for example, had virtù enough not to publish The Prince during his lifetime. It was published in 1532, 5 years after he died. But back to the Wheel of Fortune, Fortuna's wheel. That was a preoccupation of Ignatius Reilly in the novel Confederacy of Dunces by John Kennedy Toole, which was written in 1963. Now, that novel is, by any objective criterion, the funniest American novel ever written. And it was written 431 years after The Prince was published. And it was comic because Ignatius Reilly lacked virtù, to say the least. Now, 5 years later, 436 years after the publication of The Prince, the metaphor shows up again in the jazz rock fusion band Blood, Sweat, and Tears, their first big hit, which was called Spinning Wheel. Now, when I was a kid, or I should say, when I was a child, I spoke like a child and listened like a child. Spinning wheel to me evoked the device for spinning thread or yarn from fiber. No, very definitely David Clayton Thomas sang of the same thing John Kennedy Toole wrote about, and the same thing which Niccolò Machiavelli employed as a metaphor to describe the context for fundamental human problems, which have everything to do with investors and investment and the fate of one's money. Now, in 1968 also, Richard Milhous Nixon was elected president. And it was he who, on August 15th, 1971, 439 years after the publication of The Prince, ended international convertibility of the US dollar to gold. This created a new dimension for Fortuna's wheel to do its spinning. That dimension is the subject matter of a new article on AccreditedInvestorMarkets.com. The article is entitled, "It's Wall Street versus China. How should investors view gold now?" And the article is dated October 8th, 2015, very recent. And it was written by Drew Mason. Drew Mason is Director of Asset Management for DealIndex Metals. Drew Mason knows from gold and silver, platinum, and so on. Well, Mason contrasts the attitude toward gold by investors in the United States with that attitude showed by investors in China and India, for example. And I'm quoting from the article. Wealthy Americans should welcome a rational conversation on the real benefit of gold as foreigners understand, namely, that gold is beautifully uncorrelated to the dollar. Thank you, Richard Nixon, for that last part. You see, Americans have run from gold. The Chinese investors he refers to and the Indian investors he referred to have not. And Mr. Mason wishes us to consider that gold is down, but it might be up again. The dollar is strong, but it might be weak again. Or, to go back to David Clayton Thomas, what goes up must come down. Spinning wheel, got to go round. Talking about your troubles, it's a crying sin. Ride a painted pony, let the spinning wheel spin. I sang that just to suggest that David Clayton Thomas has something to tell investors, especially investors in gold, those who are shying away from gold. It may prove to be a valuable insurance policy, not if, but when the dollar weakens again. Also in Accredited Investor Markets.com is an article by the estimable master financial journalist, David Friedman. The name of the article is The Difference Between Private Equity and Venture Capital. It's not a new article, but I bring it up because of reasons I'll get to in a moment. But private equity and venture capital are important distinctions. They're very different things, although sometimes they're the same thing. And to a financial advisor or a sophisticated investor, these are just terms they use. But not everybody knows these terms. Many accredited investors don't know really the difference. And Mr. Friedman points out the differences and even gives you a table to help you lock in an understanding of what the two things are and what they do. I want to suggest, if you want to learn more, you should go to financialpoisewebinars.com and look at the webinar offerings we have, because we are in 2015, in November 2015, 8 episodes into the 9-part Alternative Investor Basic Series of 2015, which are webinars, which some are devoted to venture capital. One is devoted to private equity. One is devoted to hedge funds. One is devoted to pre-IPO shares. Here we have investment professionals speaking in plain English about the differences among these very important institutions. Finally, I'd like to talk a little bit about something we talked about a few weeks ago. Philip Tetlock is a political scientist we discussed a few weeks ago. We discussed his experimental data set from the Good Judgment Project. It is Tetlock's conclusion, based upon the data, that ordinary people who think straight, that is, who think probabilistically and in a systematic fashion, can outpredict, in fact, do outpredict experts on the future with regard to the expert's field of expertise, that is, notwithstanding the specialized knowledge of experts. Ordinary folks who are not experts and don't know what they know, but who think straight and probabilistically systematically outpredict experts. Well, that's something to bear in mind. How you think is more important than what you know. Maybe how you think could be folded into the Machiavellian quality of mind he calls virtu, which is to see things clearly off the bat. Anyway, there's an article in the Weekly Standard dated October 19, 2015, about how a team of Harvard University debaters were defeated in debate by 3 violent criminals. This was part of a program run by Bard College that aims to give motivated inmates a liberal arts education. So they were defeated in a debate by members of this program. One of the Harvard debaters told the Wall Street Journal that the team was surprised by their opponent's preparation. Quote, "They caught us off guard," said Aeneas Carell, a 20-year-old junior from Chicago. End quote. Further, unlike the Harvard debaters, the violent felons could not use the internet to research their arguments and had to submit any requests for books and articles to the prison administrators for approval. So these, I assume, men outthought but mainly outworked the highly credentialed students from Harvard. The inmates also beat West Point, by the way, in 2014, although there was a rematch, and West Point obviously came loaded for bear and won that rematch. The point, when you're looking at investment professionals, don't be lost in their credentials. They should have virtu if they're going to help you manage the turns of Fortuna's wheel. And virtu is not the same thing as credentials. In fact, it's anything but. It involves thinking clearly, and it involves not mailing it in just because you're a Harvard undergrad or graduate. Otherwise, Fortuna's wheel just might crush you. Neha Manaktala is founder and CEO of DealIndex, Inc., which is based in London. Neha's career includes investment banking with Morgan Stanley in Mumbai in the early 2000s, recruitment then by Lehman Brothers to establish its investment banking division in India, another stint with Morgan Stanley with its technology investment banking team in London, and then on to AIMkts Private Equity, the leading global pan-emerging markets firm. In 2012, Neha co-founded and became COO at Visibi, a mobile video publishing platform which itself aggregated original videos captured and shared by journalists and publishers, and its clients included the BBC. In 2014, Neha co-founded DealIndex, an alternative finance aggregator. One review of its site, I assure you, and the site is at www.dealindex.com. One look belies the modesty of that description. The offerings of DealIndex are global and comprehensive. Just remember, they have a dashboard, is what they call it, and it dazzles. It is our pleasure to speak with you, Neha.
Thank you, Chris. Great to speak to you as well.
All right, so DealIndex is an alternative finance aggregator. Please describe the principal functions of DealIndex and its scope, and what inspired you to do this.
Sure. So as you mentioned, DealIndex is an alternative finance aggregator. What we do is that we take a global and curated approach to the alternative finance ecosystem, and we provide extensive data, research, analytics as part of our service to clients. Our flagship product, as you mentioned, is the dashboard. And through the dashboard, our clients are able to view private companies which are raising capital in real time across different asset classes, including equity, real estate, debt. And we provide extensive data on these transactions so that there's enough data which is backing these live deals. The principal functions include the ability, through the dashboard to track live deals, track historical deals, but more than that, adding value to the deals and the data above just what we get from the platforms, giving it the right context, putting enough extensive insights, the right tools, filters, visuals to allow investors to better compare, monitor deals, and also to view trends in deals that have actually raised capital, which we've tracked in real time. So that's part of the dashboard's offering. We do also provide research on a quarterly basis. Our first report we issued in July, which is focused on the equity crowdfunding space. And our whole perspective is to add value as an aggregator and to provide the right level of insight and to build a product that's something which is more mature and provides the right level of diligence and screening tools which will allow investors to have a better overview of this market and to analyze deals better.
So let's get to that Democratizing Finance, which is a great report that you put together, your first of your quarterly reports, in a minute. But I want to get back to the dashboard. I was just on the dashboard, not for the first time. And your description, of course, is apt, accurate, and helpful. But I wanted to emphasize that you can sort the offerings by geographical area. Let's say you're interested in European or African or South American deals in that region, and you can select that. You can select by economic sector, and also interestingly and crucially, I think, select by maturity of funding, and that's just 3 of the selectors. So if you're interested in later stage, pre-IPO kinds of places, what kinds of deals are being made, you can zero in on that data pretty handily on this aggregator. It's really something.
Yeah, I think, a lot of what we do is the data comes in a very raw format, and part of our offering is to standardize that data so that you can compare the deal in the UK with the deal in New Zealand, with the deal in the US, which might be in the food and beverage space, to be able to compare what their customers are like, how much they're raising. And it's also useful for issuers, and we have worked with several issuers and founders. And, for them, it's really insightful before they undertake an offering to actually be able to view which platforms are successful in their space to raise an offering, what's the sweet spot in deal sizing. So the ability to see the data in any currency you want, and then also provide the right intelligent filters on top of that to be able to sift through and customize it to what you like. You can see deals that are overfunding. You can see deals that already have a sponsor to it and so have come on to a platform with an angel investor or a VC investor that sponsored the transaction. It's insightful, and even doing the historical deals is very exciting for us. I mean, we look at sectors that are getting funded. I mean, as you would imagine, technology is obviously is the one which gets the most traction through these online platforms. But you also have biotech and health tech and agriculture which are getting traction. And increasingly over the past few months, you have seen more mature companies in the UK, in Australia. There was an example. A company which was doing an IPO, which did a part of its offering through a New Zealand-based platform. So it is interesting to see the industry growing, and even through tracking the data, we can see the maturity of the whole industry, and just the ability to capture that all through the dashboard is exciting for us.
I imagine that early stage companies, maybe not the earliest of early stage companies, but those who are about to make a presentation to some serious venture capital, benefit by doing research on the dashboard to demonstrate to the VC people how they differ, how they may, but also how other companies in their sector have done.
Yeah, it is. I agree with you. It is really valuable.
So were you inspired to do this by the ability that you hope to develop to compare apples and oranges in a meaningful way? Is that what really got you going here?
Yeah, I think it's a combination. I mean, you mentioned the Grow VC Group in the start. The DealIndex is co-founded by the Grow VC Group and myself and the team. And it's a combination of their experience of having been in the digital investing and lending space for so many years now, and my own experience in investment banking and private equity. I think the one thing is that's the game changer is this availability of this private company data. I mean, even for someone who's been in banking, private company information was always difficult to source, and the sheer act of having companies raise capital online means by default you have more data available on companies. You have data regarding their funding, you have data regarding their market, their products, everything that they need to provide investors to convince them to invest. So the combination of this data is what inspires us the most to put a product like this together. But it's also then to use the learnings from my past, which is using sophisticated tools, the right processes, the maturity of tools, which is portfolio management, tracking, what happens to companies after a year, are they still around, did they deliver on what they promised in the capital raise. So it's just to view this whole trend of digital finance and crowdfunding and combine skills from what I have learned and the team has learned in investment banking and private equity, the right software and the right tools that allows more transparency in the space through data, and allows transparency from the issuer side and the investor side, and you have more participation all around in the private market. So it really is a big change in private markets and private capital formation.
Well, then this calls for two questions. One, do you get your data, actively by looking at what others passively put out, that is, they're putting it out anyway, and you harvest it, or do you have means to draw data to you through some sort of carrot that you offer to enterprises? That's one, because you were talking about data. And the other one, since you were talking about sophisticated methods that you apply from your own past experience with Morgan Stanley, I assume, and Lehman and AIMkts, is away from the dashboard, does an investment bank or a PE shop perform comparison analyses like the ones you offer?
Sure. So I'll answer the first question, which is how we collect the data. All the data you see on our dashboard is through platforms, and as you can see from our research as well, we do partner with them. It's quite a mutual relationship. Most platforms are on several aggregators already, but we work deeply with them, and we featured quite a bit of them in our research. So we do work directly with the platforms, and they also get access to all the data when they are featured on DealIndex, and they appreciate the level of insight even they get by looking at the industry trends, for example. So the data comes from the platforms, and then on top of that, we have other sources which helps to add on top of the data, which might be web traffic related to a deal or other sources of data, which is all possible because of so much change in technology. And then we have other private sources of brokers, because that's another market that's starting to change and evolve as they learn about syndication and look at stuff like angel lists. So there is a combination of offline and online sources of deals, and we like primarily to deal with the brokers or the platforms in between, and also keep some element of quality to it, because it can be quite noisy otherwise to aggregate deals. So we try and deal with platforms that are doing a good job of the kind of issuers they deal with and the kind of deals they deal with, because it can be very messy otherwise. So that's answering the first question on how we get the data. The second one is, I probably started my career doing comparable company analysis and precedent transaction analysis. It's very core of what you do, whether it's in investment banking, providing advice to companies who are looking at M&A transactions or an IPO. It's very core, especially if a company is going public, which other companies went public at a similar size, which markets do they list in, what are the traction they got. From a private equity perspective, you even identify sectors that you think you'd like to invest in that fit into the principles of investment, and every opportunity when it's looked at individually to invest in, there has to be a market overview and a comparable company analysis to understand why this company has a unique offering, what's their market share, why would I invest in it. It's core of any financial analyst job is to put a company in perspective with the bigger market. So the level of analysis that's done for public companies and later stage private companies at investment banks, and the type of tools that are there, to see that emerge in not so much early stage, but at least private companies, that's really exciting, because it probably replaces a very archaic way of doing private deals, which is through networks and through someone knowing someone, with a more transparent and data efficient manner.
Well, I can imagine that might also ease a little of the institutional investors' spending on financial analysis, because some of it is going to be done by you, and then maybe with the help of a smaller coterie of analysts. Do you think that might be true?
I think one is, if this industry has to grow and more, the equity crowdfunding in general and issuers are getting larger, there has to be this collaboration with the institutional investors and the larger financial industry. And by default, they require more information because the processes are more rigorous. And there's a reason for that, because diligence is important, commercial diligence is important. And so it is useful for them. The institutional investors and the clients we deal with would need the minimum of what we offer, of being able to analyze and compare and track, because they're used to that. And so if you want more collaboration with those investors, then you have to offer that. And by us doing this, it definitely eases that process. I mean, these kind of tools are available for bigger companies, for the public market, because of the level of data that's there. So to create a similar tool for companies at this stage, is given the level of information, is just a natural progression.
I'm going to get to the grand comprehensive question in a minute. Let's talk a little bit about the educational component to DealIndex. When I say educational, of course, you're educating through the dashboard, but I mean more narrative stuff, articles to help sophisticated persons who are not institutions or family offices take advantage of the vast information flow. What do you provide them?
I think through a combination of the data and research, it's generally more context on what's happening in the industry and what's happening in deals. So, different audience bases get different levels of information. I think from an issuer's and a company's perspective, it is very important when you're looking at your capital raise, if you're looking at doing that online, to be able to compare what's happened in the past and use data to do that. If you're a sophisticated investor, part of the reason we did the report is to demystify what crowdfunding and alternative finance meant. I mean, a lot of the institutions probably don't like the term crowdfunding, but we try to demystify that by showing actually it's a much wider movement of capital transactions. So that's the reason for the report, is to really explain the momentum behind it through the primary research we've done. And for less sophisticated investors, which is probably the most relevant in the UK, because that's where equity crowdfunding has been happening in its true form for a long time, it is useful to be able to have this level of data that of an institution, a VC, or sophisticated investor would have, and to be better informed about what are the tools you should use to analyze an investment. I mean, we look at investments in the UK which come to the crowd, which you can invest as little as £50, and some deals will move purely because they're in the food and beverage space. I think through the provision of the right tools, the average investor, which is the crowd, then the service we provide is so that they start getting smarter about how they should be making decisions, or at least put it in the right context. We're not telling them what to invest in, we're just giving them the right tools to make that decision better. You should be looking at the team, the market, the product, the competitors, the traction, what's the opportunity, how is the capital going to be spent. So these are the parameters by which you should be judging it. And these are the parameters largely which institutional investors will use, and more than that. So at least these are the basic parameters which the crowd should invest. Because if the crowd is getting more involved, which they have been in the UK, then they need to be smarter about investing in these assets, because these are risky assets. They are quite illiquid assets. So it is useful to have the right tools to do that.
Well, you're espousing one of the themes of accredited investor markets generally, so thank you. I think in your Democratizing Finance, Alternative Finance Demystified, your first quarterly report, which, by the way, has an immense amount of data. If there are any finance journalists out there, you'll want to read the report just to give yourself some food for your articles, because things are quantified in there, and they're quantified as of 2015. Yeah, I think you mentioned in there the growing presence of syndication, which I guess is a natural growth given the nature of crowdfunding itself. I was wondering if you might comment on how that's appearing in the market, greater syndication in alternative investing.
That's a trend we highlighted a lot in the report, the concept of syndication. And to me, that's one of the biggest outcomes and learnings of online investment. And it's also the core of sophisticated investors and institutional investors collaborating. And syndication is key because it means that global investors can invest together. Particularly platforms like AngelList and Syndicate Room have pioneered the concept of syndication. Syndicate Room is based in the UK, where they only list deals which are brought to them by an angel, and then it's vetted through their due diligence process and goes live. And AngelList is, of course, really well known in their model. And what syndication allows is that there is trust that a sophisticated investor, an angel, or a VC have done the job, has done the work, and the rest of the crowd or the whoever can invest in the transaction is going on the same terms. And there's a comfort to say that, okay, someone's done the work and we're co-investing along with them. I mean, the concept of co-investment exists in private equity and venture capital for ages. So it's just bringing that concept of co-investing and, someone being able to benefit by a person who's done the underlying work, who's sophisticated enough to at least make a judgment call on the investment. It's a great trend because it means more cross-border investments. It means investment from parties which would not traditionally have invested in these deals. I mean, sometimes, some of the clients we speak to have never invested in private companies, especially early stage. And the reason they get comfort to do that is potentially because the deal is being syndicated along with someone who's the smart money, the VC or the angel who's done the work behind it. So that's a really big trend, and that's the trend which even brokers, particularly corporate finance houses, which are the smaller mid-market players, deals below the radar of banks, in particular are catching on to is how can they use the concept of online syndication to better close their deals as well.
I would like to close with some grander themes because you're talking about syndication, which brings global investors who might not even know each other into investing with one another concerning projects that might be located in a third, fourth, or fifth country. But if the information aggregation is good enough and sound enough, something like that is much more likely to occur. So even if the amount of innovation and the amount of startups remained constant, the syndication process ought to accelerate the amount of finance and the amount of opportunities for smaller investors to participate in that. That's if it remained constant. But let me throw some math at you, if I may, Neha, which I'm sure you're a lot better at math than I am. If there's 2.8 billion people who are currently using the internet, and if one person in 100 has what it takes to be an innovator and start a business, and I don't know if that's right, but if it is 1 in 100, that means 72 million people could be starting businesses, which is a much higher number than we have right now. At any rate, it indicates that there's a lot of untapped potential for growth out there, which could only be helped, right, by functions like the ones you're performing, which tend to enable strangers to invest in one another. If that's the case, there are some serious growth prospects, aren't there, to DealIndex, among other things.
I agree. That's the larger trend of channeling global capital into ideas across the globe. So the ability to fund the right idea in Asia and Latin America. I mean, this trend of raising capital online is still largely in Europe and North America. Asia and Latin America and Africa are still catching on. So it's definitely, I mean, the whole concept of startups and this current trend has picked up out of the global financial crisis, because out of every crisis there's innovation that comes out. And I think that this trend in fintech in general, and private companies getting funding and startups, I mean, while there will be cycles, is still part of a larger trend of driving innovation and the ability to channel capital more efficiently and for ideas which don't necessarily have the right networks but are still great ideas to get funded is great. And it's great to be part of that movement.
Neha Manaktala, the founder and CEO of DealIndex, which more information can be found at www.dealindex.com. Thank you kindly for speaking with us.
Thank you so much, Chris.
Accredited Investor Markets Radio is produced by Stephanie Strait. Thank every one of you for listening, and let's do this again sometime soon.
Thank you for joining us. If you enjoyed this episode, you can subscribe through iTunes or Stitcher, or you can download our app from Libsyn. You can also listen right on our website, www.AIMkts.com. Each week, Accredited Investor Markets Radio brings you news and education about investing with a focus on alternative assets. To see a short written summary of this episode, go to www.AIMkts.com. Accredited Investor Markets Radio is a production of Financial Poise Radio Productions, LLC.